Welcome to the Real Estate Investors Weekender Podcast. This podcast is brought to you by the award-winning editorial staff at NREIOnline.com. Let's jump right into this week's top news, features, and blog posts.
Welcome to the NREI Weekender with your host, David Bodamer. You know what? Normally we're going to dive into the week's top stories, but we're going to start a series here, and that's really about the NREI Research Series. And this week specifically is going to be David's going to be sharing information from the research they've done on the multifamily sector. Good afternoon, David. How are you?
I'm doing all right. How are you doing?
Fantastic. I'm here to learn, man. I don't know much about this, so I'm excited. So tell me, why are we delving into this research? Why is this so important?
So this is something that we started doing about 6 years ago and have built out as a platform. We have, an audience of tens of thousands of professionals and experts in the commercial real estate sector that we're trying to tap into. So basically on a number of different topics, we do proprietary research where we're trying to figure out where the markets are at when it comes to different property sectors. Some of our studies are more are topical instead, or look at different what's going on with financing or what's going on with specific kinds of investor classes. But this is the one that started it all for us when we started the series, and it is the multifamily research. So this is specifically the 6th year we've done this, and for us, I think it's a helpful way to check what's going on in the market, to see how sentiments have shifted year over year when it comes to the key fundamentals in the industry, basically to inform, to figure out what investors are doing and what they might want to do based on what they're seeing in the marketplace when it comes to finance, what the capital markets look like for the multifamily sector, what the development activity may look like, what might be happening with leasing, occupancy rates and rents, those sorts of things. So that's, it's an attempt to sort of touch on that and provide some insight into the industry that's different from like our day-to-day news coverage where we're more just like interviewing what's happening in the space. This is something a more research-based thing that we do.
Yeah, the news story is very, very honed in, very specific, where the research is going to be a broader spectrum of information, which I think is great. And you said you've done this for 6 years, right?
That's correct.
So what is the major takeaways from this year's research?
So one takeaway, multifamily is the strongest of all the sectors. It's always the one that investors want to be buying. It's generally considered stable, and the findings this year are consistent with that overall. Going through, when we drill down into each of the kind of areas, what we'll see is that generally it's positive to stable on all aspects. People think that there's not much sense of that things have gotten overheated. People aren't too worried about overdevelopment. And when it comes to and when it comes to investment and cap rates, there's also it's in a pretty good shape.
Yeah. So nobody's running for the hills yet buying pet rocks as an investment or anything like that. They're still pretty happy, right? So what is the outlook for investments if you can at all speculate or think about that? What's the outlook according to the research?
So when it comes specifically to investment, what we are seeing, or what the respondents are saying, is they expect that cap rates specifically will increase, but the sentiment on that has moderated quite a bit. Whereas in the past couple of years, there was, just given that people thought interest rate, in a rising interest rate environments, cap rates tend to also rise. Now we've gone through a long period of those interest rate hikes. There's less expectation that interest rates are going to go up. So in concert with that, along with, I think, the fact that people think that the sector is pretty safe, now only about half of the respondents think that cap rates are going to rise in the next 12 months. Instead, more like 30% think there'll be no change, and even about a fifth think that cap rates may decrease, which hasn't been something that we've seen in a while. So whereas like a year ago it was more like 70% we're saying that cap rates are going to go up. Now this year we're more like 50%. So it's a pretty big swing when it comes to expectations on cap rates. Similarly, when we asked in terms of investment, we asked them, whether they plan to buy, hold, or sell. What since we are talking to investors, and we do ask for people that are specifically invested in multifamily. So what are you going to do? And what we found this year is that the percentage of people that said they want to hold was 47%, nearly half of respondents. That's actually the highest percentage we've had say that in the 6 years of the survey. Because in the past years, it's been more bullish towards like, we want to buy. Mm-hmm. And so, like there was much more sentiment. Like you go back to our first survey, 55% of people were like, we want to buy. Only a third were saying hold, and only about 10% said they wanted to sell. I think so basically, I think what that speaks to is that people like multifamily, they want to hold what they have, not necessarily be as aggressive buying. Although overall, the sentiment towards buying was still about 40%, and then only about 15% say they want to sell. So I think when you kind of put that all together, that 85% combined say they either want to hold or buy, but most of that is hold as opposed to buy. So I think what that means to me is that people like the sector, they want to hold their assets. They're not necessarily looking to buy a bunch more multifamily.
And that brings up the next question is, if they're not looking to buy, do you think there's a slowdown? Do you think occupancy rates, are they going down? Is it a concern that I like what I have now, I'm good, I'm safe, but I don't want to stretch myself, or what are your thoughts?
Yeah, I think it could be, that it does potentially dovetail to what people think may be happening with fundamentals like occupancy rates. So specifically, that's one of the areas we ask about. This year, about half of respondents said they expect occupancy rates in multifamily to rise.
Oh, really?
So they're expecting, they are expecting occupancies to go up, at least half, but then that means the other half thinks they're going to decrease or no change. Mm-hmm. So, these are always like complicated sentiments to break down a little bit, because it's not like 90% of people think it's going to get better. It's more like, all right, 50% think, half of them think, okay, we're going to have fuller properties. But then another 20% think their occupancies are going to go down, and another quarter think no change. So to me, that adds up to that's not the most bullish sentiment you could possibly have. It's not like everybody's like, things are great, supply is great, occupancies, we still have rent, we're going to go from 95% to 96% occupancy. They may also speak to that, we're asking at a national level, and obviously real estate is always a local business. So it also could be a reflection that there's softness in some markets and not others. So somebody, in a softer market may be telling us it's going to decrease, whereas somebody in a stronger market telling us it's going to increase. So there's one sort of piece of context to think about with these answers as well.
Yeah, it seems a little odd. I mean, quite honestly, I don't mean to cut you off, but it seems a little odd if half of the people think that occupancy is going to go up, and then even another quarter of them think it's going to stay level, that the trend this year flipped from the previous 5 years, and it's more of like, I'm going to hold, I don't want to invest more. If it seems like a decent part of the percentage says, I think occupancy would go up, you'd think there'd be an opportune time to get something if they're going to be able to fill it. But then again, who knows? I mean, like you said, it's different parts of the country that completely could skew the numbers in one way or another, depending on the local area. Right. But speaking to the overall, I know this research goes out everywhere. Does any of the research really address how the market feels about how much development is occurring? Does it reflect that or show that at all?
Yeah, that is another question we ask, since an experience in a lot of previous real estate cycles is always overdevelopment. You get to the point where people are building too much, too much supply, suddenly too much vacancy, drives down rents, not fun for everybody. It's always interesting to see how conscious the market is of the potential risk of overdevelopment. So in this year's survey, and so on this front, I think there's good news, because only, while that sentiment is out there, it's only 35% of respondents said that they think there is too much development happening. Last year, for context, that number was 43%. So we've never had it be more than half of respondents in the years that we've been doing saying that they think overdevelopment is occurring, but we had seen that number go up a bit in some of the years, and this year it came back down. Conversely, 38% then say that the right amount is occurring, and even 15% say that too little is occurring. And then there's a chunk that say they don't know. But the major takeaway is that in terms of being a proxy for concerns about overdevelopment, the concerns have dropped a bit from where they were a year ago. So I think that to me is a positive takeaway from this year's numbers.
Yeah. And that's, I mean, development, occupancy, everything goes hand in hand, leading right to my next question. What about rents? How are they doing? Are they sustaining? Are they going down? Are they going up? What's the trend going on?
So on rents, again, sentiment got more positive than it was a year ago. This is one, looking through the entire history of the survey, rents have been going up consistently every single year. And the people that expect them to go up in the next 12 months has always been like 70 to 80% of respondents have said that in most of the years that they expected rents to continue to rise. Mm-hmm. We would usually get like fewer than 10% saying that they expected rents to decrease. So always there's been a consistent expectation that looking forward over the next year that rents are going to go up. But then a year ago, it was only 2/3 of respondents said they were going to increase. So as opposed to previous years where it had been 75%, 80%. So while 67% is still, pretty strong sentiment that rents were rising, it did seem like potentially there might be some softening. The good news is then now in this year's survey, the number went back up again, back to over 70% of respondents saying they expect rents to increase in the 12 months. So I think it dovetails with the previous answer that they had about development. Concerns about overdevelopment have gone down. Concerns about rents possibly flatlining or falling have also gone down. So but on both of those issues, in terms of the fundamentals of the sector, there's more bullishness than there was a year ago. Mm-hmm. And so combine occupancy rates, development, rents, that's gives you a sense of what people think of the income stream of the property is going to be, that then should give them a pretty positive feeling in terms of the outlook for investing in the sector.
Yeah. And shifting gears just slightly here, and again, I know that you guys do a tremendous amount of research and you do fantastic work. I know a lot of people count on it. So what's the state of the capital markets for the multifamily sector?
That's the other piece when it comes to investment is, how you may want to invest in the sector, but how are your capital sources? Are the lenders, are the equity providers, are they willing to also, do they share that outlook on the sector? So the news on this front is also good. Overall, people are reporting that the availability of debt and equity has not dramatically changed very much from a year ago. So those capital sources are still out there. And in fact, even for, so about 50% of respondents for both debt and equity say that the amount of capital available is the same as it was a year ago. So people are not pulling back. And in addition, another about quarter of respondents said that the amount of capital has actually gone up. So I think look at those two together. That's about 2/3 of that's about 3/4 of respondents that say, the amount of financing or the amount of equity is the same or greater than it was a year ago when it comes to targeting this sector. So I think that adds up to a pretty good picture when it comes to the capital markets.
Yeah. And you alluded to this earlier in the podcast. You kind of gave us a sneak peek of this, but I want to know if you could kind of expand on it a little bit. Where does multifamily investments sit relative to other commercial property types?
Right. So this is something we consistently ask, we ask this in a lot of the different surveys for people to rate the attractiveness of each of the sectors on a scale. We give them a scale of 1 to 10. Then we ask about just the major ones. So it's multifamily, hotels, office, retail, and industrial. In recent years, multifamily used to be far and away number one, usually like on a scale of 10, usually about an 8. The past couple of years, industrial kind of rose the ranks and was pretty much neck and neck with, and in some of the surveys that we asked through the course of the year has even occasionally topped multifamily. In this particular survey, multifamily was the top spot again, just barely edging industrial. And then those two are kind of head and shoulders above the other three sectors. Both of those are, again, between 7 and 8 on a scale of 10. People right now, we give hotels and offices about a 6 on a scale of 10. That's been pretty stable. Like looking back over the whole lifetime of us doing these, those are, usually those sectors are between like a 6 and a 7. Retail is down below a 5. So that's bottomed out. It's reflects, but it's not surprising just given, with the challenges and the transformation that's happening in the retail sector. So it makes sense that it's not seen as being nearly as attractive as the other sectors, and definitely way behind multifamily.
Yeah. All right. That makes sense. Especially with all the research you guys have done. Is there any other takeaways that we need to know about this research, or the audience needs to know? Anything else that we need to hear about today?
Yeah, actually, I was thinking back in regards to capital markets, there is a big shift on a couple of the questions that I didn't talk about earlier. Mm-hmm. One of the things we ask is how readers, how they expect different aspects of financing for the sector to change over the coming year. And that includes things like, loan to value ratios, debt service coverage, interest rates, and the risk premium, which is generally the spread between 10-year treasuries and the cap rates in a specific sector. A way to capture how much risk is inherent in investing in this versus, buying a stable bond. Some of those numbers shifted quite a bit. And I think it makes sense, but it's all relative to what's happened with interest rates. For years and years, everybody, we were in the record low interest rate environment. So everyone had building expectations that interest rates would go up. But now they have gone up. So I think for a while it wasn't a particularly interesting question, because every year we had asked, do you expect interest rates to go up? And literally 90% of people were like, yes, of course they're going to go up because they're at like 0.
Yeah.
So now I think the question has become more useful, because now we've gone through those interest rates going up. So now it becomes a question of, how much more are they going to go up? And now you start to see some real uncertainty in the market around that. Mm-hmm. So whereas in the past we're looking at, everybody's expecting them to go up. Now I think there's sort of there's a split in the market as to where people think they're going to go. So only 45% now think they're going to keep going up. Another 45% think we're done with the interest rate hikes and they're going to be flat. And now even 10% think we may start to see interest rates go down again, which in past years, it was more like 90% think they're going to go up, 10% think they're flat, and like nobody. They're at 0%, they're not, or whatever, or effectively 0%. Nobody thinks they're going to go down. So, I think that could then relate to when we were looking at why would people want to hold, in addition to the fundamentals, it's this, okay, if you don't really know where interest rates are going, which it seems like there's less certainty in the marketplace around it, then you may want to just stand pat on investment until you have a better read on it, because it's going to affect your future investment. In terms of that other category, the risk premium, whether they think the spread between cap rates and what you would pay for treasuries, where that's going. In the past, a lot of people expected that to increase, that measure of risk to increase. That's narrowed a bit. So only 40% think that the risk premium may be going up this year, whereas opposed to past years, it was more like 50%. And instead, a lot more people expect stability in that metric. The other two, the LTV ratios and the debt service coverage ratios, which are dictating how much, the financing terms, there people expect there's a pretty large consensus that that's not going to move very much. So your financing terms might not change, and how much you're allowed to borrow, and how, what your debt service coverage ratio, those may not shift, but the variables may be come down to interest rates, which then will have a knock-on effect on investment itself.
Mm-hmm. David, if somebody's listening to this podcast and they're thinking, man, I'd really like to get a hold of that research, I'd like to kind of read what they did and go through it, just kind of see some of those percentages for myself. Is there a way that somebody can access that?
Absolutely. The The full report will be posted shortly to our website, NREIonline.com. We have a whole section of the website dedicated to the research series. They'll be able to find this year's report, which will include all these charts with the year-over-year comparisons. And as well, they'll be able to find all our other research reports that we do throughout the course of the year. So that's where they can find out more.
Fantastic. And I look forward to doing more of this series on this podcast, along with all the weekly news that you're bringing us. And I appreciate your time again today.
Yeah, thank you so much. Thanks for helping to talk me through the report. It's a lot to unpack.
Yeah, it sounds like there's a ton of research that goes into it, or a ton of time that goes into it. So I appreciate you sharing that with us. And thank you all for listening to the NREI Weekender with your host, David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. Again, thanks for listening today. For everyone at the NREI Weekender, this is Aric Johnson inviting you back next week for all the news that matters to you. See you soon.
Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of NREI Informa. The content has been made available for informational and educational purposes only.